Okay. I'll just pause the recording. Pause.
Yeah, I know, but let me just.
I've been following with the
Sorry, slip out.
Sorry. No, it's
That's okay, let's just drink it quickly without this one. Okay, thank you.
You're welcome.
Well, good morning, everyone. And it's so good to see so many of my clients joining on this webinar. I just thought it really important in this very, very challenging and difficult time to just spend a few minutes updating everyone on what's going on in markets, what's going on here at Pioneer, what's going on with everyone's investments. And as much as anything else, to reassure you all that we're doing our job. There's really no reason for undue concern about our finances at this time. And hopefully in the course of the next half hour or so, I'll leave everyone in a situation where you feel much more comfortable and much more confident about sort of the state of your investments and the position of your portfolio at the moment. If we go on to the next slide, you can see that it's really actually been a very good year so far for most major markets. You can see that the benchmark S&P 500 has had a very strong year, recovering its losses from 2022. The focus on big tech companies has benefited the NASDAQ. Global markets are slightly behind the US. There are a couple of outliers, as there always are, in terms of stock market performance. This year, it's primarily been China and Tel Aviv, unfortunately, which we'll come on to shortly. It's been a year where bonds have broadly been flat, which is a theme that we can pick up on in the course of the discussion this morning. And of course, just also highlighting very interestingly, gold hasn't really had much to offer this year in spite of high inflation. And on a 3-year view, in spite of the fact that we've been through the COVID pandemic and the great big, the big market sell-off from the Ukraine-Russia war, gold has really provided virtually no return over the last 3 years. It's just one of those classic things that journalists love to write articles about, is this the time now to be investing in gold? And the answer almost always is no, it hasn't been, and no, it isn't. But generally, for all clients here who've got global portfolios, it's been a year of very positive returns. And as you can see from just a broad snapshot of where Pioneer clients are so far this year, if we can go on to the next slide, you'll see that we've had positive returns on both shekel and global portfolios. So the global portfolios generally for most of my clients are up between 7 and 11% so far this year. Higher returns for clients that have taken more risk with a higher equity exposure. And if you do the maths and you see that global equities are up 15 and bonds are broadly flat, on most of the portfolios, we have done better than the benchmark. I think more impressive is for clients with shekel portfolios, where the Tel Aviv Stock Exchange has lost over 3.5% this year, and bonds have been up about 2.7%. We've provided very strong positive returns, net of fees to our shekel clients this year. And that's a really, really great endorsement, in my view, of the exceptionally strong shekel portfolio management team that Pioneer have got, and the great job they've done trying to respond to what's been a very, very difficult year for shekel investors. So what have been the key factors driving global markets so far this year in terms of a global markets update? What's happened so far in 2023? So if you look onto the next slide, you'll see there's a number of key points that we're focusing on. The first of which is that economically, the soft landing scenario has actually happened. And I remember reading 12 months ago, lots of talk of the fact that, you know, soft landing is almost impossible to achieve, but yet the Federal Reserve seems to have, at this stage, done an exceptionally good job of slowing inflation sharply in the USA without tipping the country into a recession. The economic data really has been far better than expected globally, but especially again in the United States. You know, in Europe, you've got Germany teetering on the brink of recession. You've got the UK stagnant, but the US economic juggernaut just continues to power forward. There is still definitely the possibility of a recession in 2024. The general expectation is that if it does happen, it will be a shallow one, but it can't be ruled out entirely, but that's not necessarily a bad thing for investors. For now, though, the Federal Reserve has paused interest rate increases. Longer-term interest rates seem to have topped, and equity performance has been very strong. The main driver has been the big tech companies, which have bounced back really strongly from last year. And last year, in many ways, was a wake-up call for some of the big tech companies who stopped with their blue sky thinking about what they were going to spend their money on. They stopped over-investing and just recruiting staff without thinking what they could do. They've cut their costs. They've refocused what they're doing. Facebook, Meta would be a very good example of that. That's been a big driver for earnings in the technology sector. And obviously, AI, artificial intelligence, is a big theme that's also been driving markets. And the markets have all been helped by inflation showing signs of starting to come down. So you can see some of the big themes that we're starting to think about and they're going to drive investment decisions next year. The first is the rapid falling off of inflation rates. I've put UK and US on this slide to show US interest rates are down to almost 3%. UK interest rates are also starting to fall. You know, that's a really great achievement on the part of central banks that they've managed to really squeeze inflation, which threatened to really perhaps spiral out of control 12 months ago. It's a great credit to central banks. This has been reflected then in moves in bond interest rates. So as you can see on the next slide, from 2020 to the summer of this year, the rate on 10-year US Treasury yields, which is probably the major benchmark for global bonds, has really shot up from around 1% to almost 5%. That's a stellar increase. And that was reflected in the considerable fall in bond capital values last year. But what we've seen much more recently, and the next slide shows it, is the turn in sentiment in the last few weeks. Now, of course, a few weeks don't make a long-term trend. And if inflation rates start to pick up again in the coming months, we could see bond yields resume their rise. Generally, it's expected to be very unlikely that those rises will be up to or above the peaks we saw earlier this year. But you can already see that markets are pricing in an anticipation that interest rates have peaked, inflation is falling, and that's very good for economic growth and obviously very good for investors and for markets. There's a couple of other things I want to pick up on from this year that are worth focusing on as investors and thinking about very carefully. The first is the folly that many private investors indulge in of trying to pick the best shares, or even stockbrokers and fund managers, trying to pick the best shares and almost always getting it hugely wrong. I mean, NVIDIA has been, and Meta Platforms, which is Facebook, have both provided returns of almost 200% so far this year. You know, it would have been almost impossible to have predicted that these were the two shares to be investing in at the start of the year. In fact, many were predicting the higher returns would come elsewhere, from value stocks, from banks benefiting from higher interest rates. So the approach of stock picking, as it's called, just proves consistently to be a a waste of time even, certainly not a way to deliver strong returns. And that's why in the Pioneer Global portfolios, our focus is very much on investing in broad indices. We recognize that you can't work out or guess in advance which companies are likely to outperform. The best thing to do is to be in the whole market, and then you're not taking that stock-specific risk. Risk avoidance is one of our key mantras, and therefore by investing in indices, we're achieving that. And all of our clients have taken, benefited from the strong rises of shares like Nvidia and Meta, whereas a stock picking approach of individual shares, many investors who adopt that approach have probably missed the major growth stocks or the major outperformance stories so far in global stock markets. The other major theme, just to pick up on again, which is a repetitive theme, which I'm sure many of you have heard me say before, but is the continued underperformance of the UK market. The UK economy is suffering from some major structural weaknesses. It continues to underperform. If you look back at this slide from sort of 2015 to 2023, the difference in return between the US market and the London Stock Exchange has been enormous. Again, for investors who focus on the UK, because it's a story they know well, or it's because it's companies they're familiar with, or their advisors based in the UK and doesn't understand how to invest globally, the loss of performance has been enormous. And for clients on this call who are from Australia and from Canada, the story is not really that different. Home country bias, as it's called, and it's a theme I've spoken about many times before, is has proven to be a great way to destroy capital and to miss performance returns from investments. UK, Canada, Australia are consistently underperforming markets. So where does that leave Pioneer's global portfolios sort of going forward towards the end of this year and into 2024? So there are several things. The first is, of course, that interest is back. Everything can earn interest if you have the patience and the time to make sure that it does. Money left on current account doesn't earn you interest. Money invested does earn you a return, even if it's a money market account. And so we are using money market accounts for clients here at Pioneer as part of a portfolio. And on for global investors, money market account is currently giving us almost 5% interest. We're expecting that interest rates and longer term interest rates, as reflected in longer term bond yields, to remain range bound in the vicinity of 4.5% to 5%. We think that the volatility that we've experienced in bond markets for the last 2 years is largely behind us, not definitively, and we're always going to be positioning ourselves for both scenarios, but we generally believe that bond returns are going to be much more favorable in the next 12 to 18 months and add considerably to portfolio performance. This year, of course, if you remember to the earlier slide, bond markets have largely been flat. You've had great interest on the bonds that you hold, but unfortunately, capital values have continued to drift down, and that means that the net return to investors has been almost non-existent. We expect that to change in the year and a half ahead. Our approach is very much high quality, direct individual company bonds, both in shekel and US dollars. Don't want to get too technical on this, but if your investment manager or your own approach involves almost entirely investing in bond funds, you're taking, again, far too much risk in your bond portfolio. And bonds ultimately are meant to be a low risk part of anyone's asset allocation. Direct bonds give much more certainty of outcome. You know what you're going to get back and when you're going to get it. And investing in a bond fund or bond funds doesn't give you that kind of security. In terms of stock markets and equities, we still favor the USA. As I said before, Europe's got its own economic slowdown problems. Asia is influenced heavily by China. The USA just continues to be an economic powerhouse and home to most of the world's largest, strongest, most rapidly growing companies and businesses. Final points on our positioning for next year. We're expecting interest rates to stay elevated compared to where they've been in the last 15 years, which may, as I said, lead to the possibility of an economic contraction, but certainly is going to be a drag on economic growth. In terms of clients of ours at Pioneer, for larger clients where it's relevant, we're still using alternatives, using fund managers such as Apollo and Blackstone. On the piece in terms of Asia, China has got its own economic problems, and perhaps more importantly, the stock market, the Chinese stock market, doesn't reflect the growth opportunities. There's been too much political interference in business in China, etc. So China's a market that we're currently steering clear of. So that's for clients who have got money invested in global portfolios with Pioneer. For clients invested in the Israeli Stock Exchange, I was remembering when I put this slide presentation together, a very, very famous quote from Queen Elizabeth II, perhaps the most famous quote she ever made, when she said at the end of one year, it's turned out to be an annus horribilis. And I think anyone living in Israel, as we all do, who's experienced what's happened in Israel in the last year, will say that without a shadow of a doubt, this has been an annus horribilis. So, of course, the year started with unprecedented demonstrations and opposition to the government's attempts at significant judicial reform, had a really hard impact on the value of the shekel, on the Israeli economy, on the high-tech sector, and then, of course, our darkest day, the 7th of October, a nightmare that we've now been living with for the last 6 weeks. Thank God some of the hostages are on their way home, but obviously far too many of them remain trapped in Gaza. And that's really obviously been overshadowing all of our thoughts and perhaps making us not think so much about our investments, except the general anxiety and worry that I think almost everyone is experiencing, perhaps is being unnecessarily sort of projected onto our investment portfolios, which was really the reason for this morning's presentation. So I think I've already shown very clearly that global portfolios have had a very good year. Global markets are entirely unaffected by pretty much anything that might happen in Israel. The Israeli economy obviously has been affected, as has the shekel, but as I pointed out earlier, clients at Pioneer have still seen decent positive returns on their shekel portfolios this year. And what we've seen is with the US dollar, Israeli shekel has been really interesting after a very long period of shekel strength against the dollar. As I said at the start of this year, if you just go back to the previous slide, please. At the start of the year, we saw a sort of significant drop-off in the value of the shekel, which moved from about 3.25 and went above 4 very briefly at the start of the war. What we've seen is a steadying of uncertainty and capital flows back into the shekel, and the shekel has moved much back towards 3.7 to the dollar. That's a sort of 10% recovery. And the slide on the right, the graph on the right, really shows that very clearly, a very dramatic move in the shekel from almost 4.1 to 3.7 as a mark of confidence in the long-term strength and security of the Israeli economy. And again, just very briefly to recap, shekel portfolios, in spite of the big negatives on the Tel Aviv Stock Exchange, have been up in the region of 5% net of fees this year, which obviously is very, very encouraging. We move on to look at the positioning for 2024 for Pioneer clients in shekel portfolios. Again, we're using money market funds as part of our strategy. We're getting 4.5% with pretty much daily liquidity. So I'd suggest that if you're holding large amounts of cash in the current account in shekel in your bank, might be worth thinking about adding that to the portfolio. We can add it specifically to money market funds if you want us to do so. We're also focusing in Israel, as we are globally, on high quality direct bonds to give a proper lower risk strategy as part of asset allocation. We're also using index linked company bonds, which is really a unique investment opportunity here in Israel, because they provide sort of the security of individual bond investments, but considerable protection against inflation. And obviously inflation still is an issue here in Israel, and shekel weakness has probably added to inflationary pressures. In terms of equities within our shekel portfolios, we're still favoring global equities, specifically the USA, which has provided a good sort of fillip to the poor performance of the Tel Aviv Stock Exchange. We're underweight Israel equities because of the uncertainty in the short to sort of medium term for the Israeli economy, but there are a number of high quality companies that have got good prospects regardless of how long the war continues. There was actually a comment from the head of investments at one of Israel's biggest investment houses last week. More investments to say that, in his view, the Tel Aviv Stock Exchange was the best value stock market in the world. At times like this, when we are faced with considerable uncertainty, and last month I actually celebrated, not really, didn't get to celebrate it because of what's been going on, but marked 30 years in wealth management and financial advice. I was reflecting on all the market ups and downs that I've seen through that lengthy period. I know some of you as investors have seen far more than that. And some of the key issues to be thinking about at this time, which remain relevant and perhaps even more important when our minds drift to our money and we start to perhaps rush to conclusions that are the wrong ones to reach. So I really wanted to focus on just a few key things just to remember at this time. The first of which is the importance of staying focused and keeping your head while others about you are losing theirs. So the first, again, it's a much repeated comment, a much repeated statement, but actually these kinds of adages have been tested and proven by time, and they remain as relevant today as they always have been. And the first of them is the importance of time in the market, not timing the market. And this year, again, even for global investors, as you can see from the next chart, hasn't been a straight upward one-way journey where stock markets have just risen in a straight line. It's been a year, as every year has been, of volatility. So if we look firstly at positive real returns, and we're using the US as the best market because it's the world's largest, and this data goes back to 1871, so it's 150 plus years of stock market data. The first question is, it's not worth trying to time the market. What matters is your time in the market. So this bar chart shows the probability of having a positive return above inflation from US shares. So if you're investing on a 3-month basis, possibility that your 3-month term will be a positive one is slightly over 60%. If you have a year as your time horizon, then almost 70% of the time you'll end up the year with a net positive return after inflation. Over 3 years, that probability rises to almost 80%, over 10 years to almost 90%, over 20 years to almost 100%. It's really, really important to remember that financial markets are a breeding ground for poor investment choices, because there is fear and there is greed that is driving many investor decisions, and short-term markets are driven by sentiment, not by economic or market fundamentals. And that's important if you're a speculator, but if you're a long-term investor, that cacophony of news, that fear and greed driving short-term decisions really isn't very important at all. And the longer you stay in, the longer the returns. And this chart shows that in a different way. The blue line shows really what you get each year on a rolling 10-year returns on equities versus 1-year returns. So the blue line is 1-year returns. If you invest at different points along that last 150 odd years, what's your annual return been? As you can see, some years it can be high, some years it can be low, but each year is very, very different. But if you look at rolling 10-year returns, you can see there's a remarkable consistency to the kinds of gains that stock market investors enjoy. And it's very, very important, again, as we're long-term investors, we're not short-term speculators, to be thinking about that orange line and not that blue line. Because whilst that blue line affects your quarterly Pioneer valuation, it really doesn't affect your returns over time. Your returns over time are driven by the orange line, which is remarkably stable. The second theme is the importance of patience. And again, this year has been a year with lots of big stories. It's very easy to sit here at the end of November and say that markets have given, returns of 14, 15% globally this year. But there's been a lot happening in between. And if you watch the news on a daily basis and you become consumed by the news, and therefore fear takes a hold of your investment decision-making, you can make big mistakes. So the year started very positively, feeling that the impact of Russia-Ukraine and energy price rises was largely behind global markets, that economies would recover from COVID, that inflation was going to be under control. Then we had the Silicon Valley Bank collapse and the failure of Credit Suisse, which caused pretty much all the gains of January and February to be wiped out. Gradually, markets warmed to the theme of things were going to get better until the summer. And then there was a remarkable change in sentiment, where there was a fear that markets were overpriced, that recession was coming, that interest rates were going to keep going up. And that caused a rapid sell-off from the summer until the beginning of November. So at one point, having been 18, 19% up, markets then fell all the way back to low single-digit gains of about 3 or 4%. And again, sentiments changed now, and we've seen a very rapid recovery in November. And those stories of famous hedge fund managers who were shorting the market in October, maybe they made some money quickly at the start, but if they stayed with their position that the markets were going to fall, they had been very badly burnt, because timing the market is just almost an impossible task. As I said, in the short term, markets are driven by volatility. In the long term, markets are driven by economic sentiment. Yes, it's painful in the very short term to get there, but the rewards are high, and the rewards are high because of the pain of getting to those rewards. And this chart, which just shows long-term market returns over the last 35 years almost, investing in the US market, again, just shows that patience has its reward, and making emotionally driven tactical mistakes in the short term is one of the biggest risks that investors face. Just have to remember, the media and financial markets are story-generating machines. They need stories to attract interest. But as longer-term investors, we have to detach ourselves from that. And even this year, by detaching ourselves from all the noise, we've been rewarded for it. Because the biggest mistake is to chop and change. Now, of course, it's really important to manage a portfolio actively on an ongoing basis, to cautiously make changes, and that's what Pioneer's job is. We're constantly reviewing portfolios, working out all sorts of things in terms of how to invest funds that are available, what to sell, what to buy. But often our biggest decision is simply what not to change, what to stay with. And there's a really, really interesting academic study that was done a few years ago about goalkeepers, football goalkeepers, the world's best goalkeepers. And it was a survey done and published or a research work done in the Journal of Economic Psychology, published in 2017. So in 2007, it remains as relevant today as it did 15 years ago. Coincidentally, pretty much all the authors are either Israeli or Jewish, but that's beside the point. And it talked about the action bias again amongst the world's best goalkeepers in the case of penalty kicks. And what the statistical analysis showed was that if a goalkeeper stands up until the ball is kicked, the probability of saving the penalty is far, far higher than if they either dive to the right or to the left. But as any football fan knows, almost always the goalkeeper is going to dive. Sometimes they get it right, sometimes they get it wrong. So the researchers did a survey of the world's leading goalkeepers and asked them the question, why do you dive? The statistical analysis is really clear. You stand still, you've got more chance of saving at the last minute. If you dive, you've committed. And if you get it wrong, there's nothing you can do. And the response they got back from the vast majority of the world's goalkeepers was quite simple. If we stand still when the penalty is taken, it looks like we've done nothing. If we dive and we get it right, we're a hero. But if we dive and we get it wrong, at least we tried to guess and we tried to save. And therefore, we're not going to be booed and barracked by the fans in the stadium. And that kind of sentiment is definitely reflected on many private investors who feel this overwhelming impulse that they have to make changes to their portfolio. They look at the current situation as it is on that particular day. They go with their view that they find the most credible, and they'll make changes according to it. But the problem is that constantly chopping and changing and panicking and rushing to make adjustments to a portfolio as a result of that day's news really just is a recipe for disaster. And as I said a few moments ago, making emotionally driven tactical mistakes is one of the biggest risks that investors face. And it's something that the team at Pioneer strenuously works on avoiding, remaining focused on our strategic objectives remaining focused on our asset allocation and the strategy that we're taking. Because trying to second guess which is going to be the best stock market to invest in next year really is not, as I've said many times, a proven strategy for success. It doesn't matter which asset class you invest in. If you just pick one, chances are you've chosen the wrong one, but diversified portfolios remain and always have been the best way to go. Diversified portfolios, which mean that making one decision doesn't cost the entire portfolio, is absolutely the best way to accumulate and build and protect wealth over the longer term. Got a few questions to come in, so if we can just, but before we do that, before we deal with some questions, perhaps I just wanted to conclude on a couple of points. The first, of course, is that I'm always here to answer questions. I'm always here. If you want to email me, WhatsApp me, call me for an update. Of course, remembering that the biggest issue facing us, all of us today, is the successful outcome of the war, that our soldiers should be safe and victorious, that those that have been injured should get well very, very quickly, and perhaps most importantly of all, that the hostages, all of them, every single one of them, should be returned speedily, and that Israel can return to being the Israel that we knew before the 7th of October, once this current nightmare is past. Very quickly, just a few questions. First one was, a few were submitted before the webinar. One was, are we able to take measures to maintain the value of the portfolio? I think the answer to proven today is yes, we can. Diversification, not being driven by panic, and smart investment decision making. We've protected portfolios very, very well this year. Second question I had was about US dollar and whether what the impact will be of Biden's economic policy, digital dollar, and the promotion of BRICS as an alternative world currency. Our view very much is the dollar remains the preeminent global currency. America is the world's preeminent economy, by far the strongest. There is no real competitor to the US. China's got huge problems of its own. The BRICS states can't agree on almost anything, apart from the fact they want to be taken more seriously by the rest of the world. The digital dollar doesn't really, at this stage, show any sign of having any kind of impact on the dollar strength. So, of course, currency diversification remains important. People living in Israel, of course, need to have money invested in shekel because you need to match assets and income with your liability and expenses. All that remains unchanged. But in terms of from a global perspective, we don't see there's any key sign that the dollar supremacy is going to be weakened. Third question I got was, where are bond rates likely to be going in the next year? I think I've covered that. We expect bond rates to have peaked. There might be short-term fluctuations, of course, but what bond investors can look forward to, hopefully in the coming years, is a very strong stream of income from high-quality bond investments, which will be a major contributor to portfolio returns in the years ahead. And then the final question was about Israeli-based companies on the Tel Aviv Stock Exchange and how the war is impacting them. And I think that's an issue we've covered. Yes, there are definitely companies that are cheap. Yes, there are definitely buying opportunities. And definitely there's investments we want to be exposed to. But obviously there are risks and uncertainties that are specific to the Israeli economy at the moment. So we're taking a cautious approach with Israeli equities, and we are overweight in global markets in our shekel portfolios, because we feel that in the short to medium term, there's perhaps better potential being overweight there than there is overweight in the Israeli economy. I think that's pretty much everything for this morning's presentation. I'm really glad so many of you were able to join. I find this is a really, really important way to keep in touch with clients, to keep you updated and feel updated with what's going on. Obviously, everyone is very, very distracted by the news, very absorbed by the news, very anxious and concerned about what's going to happen next. And these are things we have no control over, of course. But I just thought it was very important that everyone at least walks away from this 40-minute presentation with the knowledge that Pioneer continues to be doing an excellent job of looking after client money. Interestingly, in the last few weeks, I've had a couple of clients who also have money with Canada Life, having taken advice before they left the UK, but seen just how poor their Canada Life returns have been in comparison with the Pioneer returns, which is something I've been speaking about for a long time, these overpriced, poorly invested offshore bonds with firms like Canada Life. And as I said before, if there's anything you want to talk to me about, please send me a WhatsApp, please drop me an email. I'll come back to you. We can arrange a catch up on Zoom or in person or on the phone. But for now, keep safe. And please God, as I said before, we should very soon see Israel's army victorious in the war, a Highland home safely, and all of the hostages home with them as well. Thank you very much for joining. Keep well.